Good day, ladies and gentlemen, this is Professor Ma. The following news on GIC was published today in Channel News Asia, www.channelnewsasia.com. Singapore Sovereign Wealth Fund GIC posted for the latest financial year its highest returns since 2015, but cautioned challenging prospects ahead amid sticky inflation and other economic headwinds. To manage these risks, it said it would continue to focus on investment opportunities with stable long-term returns, such as infrastructure. In its 2022-23 annual report released on Wednesday, July 26, GIC said its 20-year annualized real rate of return came in at 4.6% for the year ended March 31. This was up from 4.2% in the previous financial year, and its highest since 2015 when real returns hit 4.9%. The 20-year metric, a primary indicator of GIC's investment performance, is a rolling return where years are dropped and added as the computation window moves. For instance, the figure for FY 2022-23 represented the average annual return of GIC's portfolio between April 2003 and March 2023, with global inflation taken into account. GIC noted in its report that 2022 was a challenging year marked by soaring inflation and aggressive monetary policy tightening, Russia's invasion of Ukraine and a deterioration in US-China relations. Both equity and bond markets corrected amid the difficult market environment. A diversified portfolio and cautious investment stance provided it with some cushion from the market correction, it said. Professor Ma notes that GIC mentions that it has a diversified portfolio. In episode 12 of Professor Ma explains why, it is shown that the Norway's Sovereign Wealth Fund, the best performing sovereign wealth fund in the world, also follows a diversification strategy. Therefore, we can see that one reason why GIC outperformed Temasek, which made a loss for financial year 2023, is that GIC follows a diversification strategy, similar to Norway's sovereign wealth fund. The second reason for Temasek's lackluster performance is due to the investment mandate. GIC is given the mandate to invest anywhere but Singapore. In other words, GIC is looking at international opportunities, hence their playing field is similar to Norway's sovereign wealth fund, and Professor Ma thinks that GIC follows a similar strategy too. On the other hand, Temasek Holdings apparently needs to hold the majority of its portfolio in Singapore companies. Professor Ma notes that this did not prevent Temasek from investing in FTX and losing 369 million Singapore dollars. How real is this constraint, and is that the reason for Temasek's lousy performance? Based on Professor Ma's analysis, the answer is no. The fact of the matter is, most of the Singapore companies owned by Temasek are doing well. Companies like Singtel, Singapore Technologies, Singapore Airlines and so on are getting good returns. So what is dragging Temasek down? Professor Ma thinks that it is due to the subsidiary known as Heliconia Capital. This is the information from Heliconia Capital's website. Heliconia Capital Management Private Limited is an investment firm that focuses on growth-oriented companies. We are a wholly owned subsidiary of Temasek Holdings. The fact that Heliconia focuses on growth-oriented companies means that their idea of investment seems to be equivalent to going to the nearest Singapore Pools outlet to bet on the latest faddish number. Professor Ma has a great suggestion on how to improve Temasek Holdings' performance. Close down Heliconia Capital and invest the funds in Singapore Pools instead. In subsequent videos, Professor Ma will explain more aspects of life. In the meantime, please help by liking and by subscribing. Thank you.